Has Congress unfairly found a fat new target for raising revenue, or simply ending a preferential treatment for a booming business? Here to debate that from New York, Pat Toomey. He's a former Republican congressman from Pennsylvania. He now runs the Club for Growth here in Washington. And here with me in the studio, Dan Pedrati, the director of the AFL-CIO Office of Investment. Thanks to both of you for joining us. Dan, you're right here next to me. I'll ask you, is it appropriate for Congress to consider changing the tax treatment of these public-private equity partnerships?
It's absolutely appropriate, Peter. The current system allows for a tax subsidy for a handful of private equity firms. And what this bill would do is take away the current system that permits one segment of the financial services industry to enjoy a competitive advantage over others. And it's also, I think where Congress is going to go with this is addressing a situation where Steve Schwartzman pays less in taxes than a firefighter does. And that's created an environment, I think, where we have the fiscal train wreck in Washington, where you have record budget deficits, record trade deficits, and that situation needs to be fundamentally altered.
Steve Schwartzman, just for those viewers who aren't aware, the co-founder of Blackstone. And Pat Toomey, your take on all this, I'd gather you've got a very different opinion about the prospect of higher taxes on these businesses.
Well, absolutely. First of all, let's look at the facts of the deficit picture. The deficit is now trivial as a percentage of our economy. It's much smaller than the average has been in the post-war era, and we're a chip shot away from having a balanced budget, in part because we cut taxes earlier in the Bush administration. We don't need a big tax increase now. Let's keep in mind the revenue, the income that comes from these funds are the appreciation of assets, and appreciation of assets are treated as capital gains. And so it's reasonable to treat it as capital gains. And let's also keep in mind the very constructive role that these funds, both private equity funds and hedge funds, play in our economy, adding liquidity, providing greater accountability in some instances, wringing out more productivity from companies. Why we want to have a huge tax increase at this time when we don't need it, which will harm this industry and drive them overseas, doesn't make sense to me.
Peter, what Pat's fundamentally arguing for here, and it's probably a unique situation for Pat, is he's saying that government should be used to redistribute wealth in favor of the wealthy. And I would be interested if Pat knew how much Blackstone paid in federal taxes last year. Zero, Pat, zero. And they admit in their prospectus that they paid 1.4% as an effective tax rate. That's fundamentally unfair when we're facing a $436 billion budget deficit, when we can't outfit troops with body armor, and we still have thousands of people homeless after Katrina. What we're talking about is making the tax system more fair, equitable, and transparent to Americans across the country.
Pat Toomey,
I don't know where these facts come from. First of all, we're nowhere near a $400 billion deficit.
Pat.
We're nowhere near a $400 billion deficit, and in fact, it was just reported on this show. It's close to $150 billion, a little over 1% of GDP. We don't need a tax increase, period. Secondly, this has been settled law for 20 years, and it's been totally non-controversial because it's a reasonable treatment on the appreciation of assets. And now to disrupt all this, frankly, what it is there's an industry that's doing quite well, in part because government has driven companies to go private because of too much regulations, because of laws like Sarbanes-Oxley. And so now people are doing very well, and so it's a fat target that Congress wants to go after.
Pat, let me jump in here and just ask you about that. The notion that they do have operated privately is one thing, but for those who suggest now that they make the decision to go public, shouldn't they receive somewhat different scrutiny? And what about the argument made by Wall Street banks, Goldman Sachs, for example, that these private equity firms may be operating very similarly as financial services companies?
Look, there's no reason why being public instead of private should all of a sudden visit a whole new tax on you, and a huge new tax, in fact. And as I say, if you do that, all you're going to do is encourage them to do this overseas, where, frankly, most recent large IPOs have been going these days because we are driving them overseas. We don't need to do more of this.
Dan, your take on that? Does he make a point? There's been a big focus on IPOs going overseas. Wouldn't you simply drive this business elsewhere?
He's fundamentally wrong about the overseas argument. And it's interesting, every time we talk about the rich in this country paying their fair share, we fall back on the competitiveness argument. First, as it relates to the tax issue, this isn't some wild-eyed policy idea. You have people like Bob Rubin advocating in favor of this, and I didn't hear Pat say that Steve Schwartzman shouldn't pay a higher tax than a firefighter. Second, we have recent reports from unbiased sources like Goldman Sachs that say that the U.S. Financial services capital markets are the most competitive in the world. And what props up that competitiveness, this. What enables it is strong investor protections like Sarbanes-Oxley that restore investor confidence and make this an argument, a capital market where every venture capitalist wants to come.
Yeah. Let me ask you a question, Dan, here, an argument that's come up as this discussion first began. First, with the notion of perhaps changing the tax treatment of this carried interest, the 20% cut that private equity firms, hedge funds get right now. There's some, even before this debate over companies going public, these firms going public, there was this debate about changing the tax treatment of that. Your take on that issue, is that a separate issue in your view? Is that also the right step for Congress to take?
I think that is the right step. And again, we're talking about equaling the tax treatment here, making fundamentally what these people are providing, and this is what Bob Rubin was saying last week, is a service. This isn't a form of capital gains treatment that they should be receiving. And by equaling out and charging them the higher rate, what you're essentially reflecting what they're doing, which is providing a service and opening that part up.
Pat, do you have any, do you also disagree with the notion of going after this carried interest, this 20% cut, and changing the tax treatment of that for the same reasons you've articulated earlier?
Essentially, yes, and I note with interest and concern that, you know, this effort to impose this new tax on, first it's the publicly traded partnerships, and next it'll be the private ones, and next it'll go beyond private equity and hedge funds and get into real estate. Who knows where it ends? No, I actually think that the management fees themselves, the 2% fees, which some have managed to defer and treat as capital gains, they ought to be treated as ordinary income. But again, the appreciation of the assets, that is a capital gain, and when it's shared with the managers, it should be treated as a capital gain. We don't need to have a big tax increase imposed on this industry.
Peter, one other thing I would note, and I think the tax issues are one issue of concern. There are others as well, and we've weighed in with the SEC and said that Blackstone should be registered as an investment company. We have concerns about senior managers here selling out when the private equity bubble is about to burst. We have concerns about the governance, that you can't, as a shareholder of Blackstone, vote for directors or vote on executive compensation. And finally, it's our understanding that with the newly created public company, Blackstone LP, that the Chinese government will actually own over 40% of it and not the 10% that they claim in their filings.
Let me ask you about one thing that's been pointed out to me. A lot of unions out there have invested their pension money in private equity shops like Blackstone. Is it hypocritical for you all to be challenging the structure of these businesses when at the same time you've got pension money going in?
No, I think what we're saying is, and again, our members' deferred wages are invested in these companies, that they should be invested in a responsible way. They should be invested in a structure that allows for transparency, which we don't have. And as you mentioned, when you go public, you agree to abide by certain rules that everyone else participates in. And I think we're saying that as significant investors, we want to see this done the right way and the right regulatory framework in place.
Pat Toomey, you're a former member of Congress. I'll give you the last word here. First of all, is this going to happen? Do you think Congress is going to pass something like this, and would the Bush administration agree to it?
I think Congress might well pass something like this. I think the Bush administration would veto it, and I doubt they would have the votes for an override. But if it were to come into law, you could see diminished returns for the pension funds and the universities and the foundations and all of the numerous millions of people who've been benefiting from the good performances of this industry.
All right, Pat Toomey, Dan Pedrati, thanks to both of you.